Hey, crypto community. Ever feel stressed about trying to time the market perfectly? Today, we're going to introduce you to a simple but powerful strategy that can help: dollar cost averaging, or DCA. Let's break it down. The problem with timing the market. Trying to buy at the absolute bottom and sell at the absolute top is nearly impossible. Many investors get caught up in the emotional roller coaster of market highs and lows, often leading to poor decisions and missed opportunities. So, how can we avoid this stress? What is dollar cost averaging, DCA? Dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price. For example, instead of investing $1,000 all at once, you might invest $100 every week for 10 weeks. When the price is high, your fixed amount buys fewer units. When the price is low, it buys more. Over time, this strategy averages out your purchase price, reducing the risk of buying in at the market peak. Why use DCA? DCA is so popular because of its key benefits. Reduces risk. It minimizes the risk of a single large investment at the wrong time. Removes emotion. It takes the guesswork and stress out of trading. You stick to your plan no matter what the market is doing. Builds discipline. It helps you build a consistent investment habit. Ideal for volatility. It thrives in volatile markets like crypto, allowing you to buy more when prices are low. So, if you're looking for a simple, disciplined way to invest, dollar cost averaging is a great strategy to consider. It's about consistency, not timing. If you found this explanation helpful, give us a like and subscribe for more essential crypto tips. What other investment strategies do you want us to cover? Let us know in the comments. Thanks for watching.